Have you ever noticed how some trends in life seem to feed on themselves? Think about a blockbuster movie that everyone is talking about. The more people watch it, the more others feel compelled to buy a ticket, driving its popularity to heights no one could have predicted. In the world of investing, there is a powerful, almost counterintuitive idea that works the exact same way. Most of us are taught to buy things when they are cheap, to look for bargains. But what if the real secret to growing your wealth is doing the exact opposite? What if the safest, most profitable move is to buy things that are already expensive, simply because they are going up, and sell them the moment they start to slow down? Today, we are looking at a legendary approach to the markets that turns traditional wisdom on its head. This concept is known as momentum investing, and today we are backtesting one of its most famous implementations, the 12-month momentum strategy, Jagadish and Titman, originally popularized by academics classical technical analysis. In 1993, these researchers published a groundbreaking study that shocked the academic world. Up until then, the prevailing theory was that markets are perfectly efficient and stock prices move randomly. But Jagadish and Titman proved that assets which have performed well over the past 3 to 12 months tend to continue outperforming over the next several months. Today, we are putting this classic theory to the ultimate test. We are going to apply this exact model to the S&P 500 ETF, ticker SPY, over a full 10-year period from 2016 all the way to 2026. We will look at every single trade, analyze the risks, and see if this academic theory actually translates into real-world profits. Before we look at the data, let's understand how this strategy actually works. The core idea of the 12-month momentum strategy is to measure the rate of change in an asset's price over a one-year look-back period. However, there is a vital twist that many amateur traders miss. In their original research, Jagadish and Titman discovered that the most recent month's performance often suffers from short-term noise or mean reversion. To fix this, professional momentum models often use a 12-1 momentum indicator. This means we look at the price performance over the past 12 months, but we completely ignore the most recent month. If this net momentum value is positive, it tells us the asset is in a strong, sustained upward trend, triggering a buy signal. If it falls below zero, it indicates the trend has broken, signaling us to exit or stay in cash. This simple mathematical filter is designed to capture the meat of major market trends while filtering out daily market noise. Why does this anomaly exist in the first place? If markets are efficient, shouldn't these profits be immediately competed away? The answer lies in human psychology. Behavioral economists have found that investors consistently suffer from two cognitive biases, underreaction and overreaction. When a company releases great news, investors initially underreact, causing the stock price to rise slower than it should. As the trend becomes undeniable, Wall Street analysts raise their targets, media coverage intensifies, and fear of missing out, or FOMO, kicks in. This leads to herding behavior, where everyone rushes to buy, pushing the price far higher than fundamental value. Momentum strategies exploit this exact human behavior. They don't try to predict the future or find undervalued gems. Instead, they simply ride the wave of human emotion, getting in after the trend has clearly established itself and getting out before the inevitable crash. To see if this behavioral edge still holds up in the modern era, we set up a rigorous backtest. We chose SPY, which tracks the S&P 500, as our testing ground. This gives us a highly liquid, representative asset of the U.S. stock market. Our backtest spans from July 28, 2016 to July 28, 2026, covering exactly 10 years of market history. This decade is incredibly rich with different market regimes. It includes the massive pre-pandemic bull market, the sudden and violent COVID crash of 2020, the inflationary bear market of 2022, and the explosive artificial intelligence rally that followed. Our execution rules are simple and systematic. At the end of each month, we calculate the 12-1-month momentum. If it is positive, we enter a long position. If it is negative, we exit and hold cash. Let's look at exactly how a typical trade anatomy looks under these rules. Let's zoom in on a specific period to see this mechanism in action. During a major market transition, the momentum indicator acts like a heavy steering wheel. It doesn't react to a single bad day or a brief panic. It requires a sustained shift in the underlying price action to cross the zero line. When the market is in a steady uptrend, the 12-1 indicator remains comfortably positive, keeping us fully invested and compounding our gains. But when a true bear market begins to develop, the price action over the previous year begins to deteriorate. As those older, high-performing months fall out of our look-back window and are replaced by lower, recent prices, the momentum score drops. Once it crosses below zero, the strategy issues an exit signal. This lag is a deliberate feature. It protects us from selling too early during minor corrections, but ensures we exit if a major, multi-month decline is underway. Now, let's look at the actual performance results over this 10-year period. When we plot the performance of the 12-month momentum strategy, Jagadish and Titman, against a simple buy-and-hold strategy, the results are fascinating. Over the entire backtest, the strategy executed a total of 13 trades, achieving a win rate of 53.8%. In terms of absolute performance, the strategy generated a total return of plus 33.5%, which translates to a compound annual growth rate, or CAGR, of plus 2.9%. In comparison, simply buying and holding SPY over the same period returned plus 300.3%, representing a CAGR of plus 14.9%. Looking at the equity curve, we can see how the two lines track each other closely during strong bull markets, but diverge dramatically during periods of market stress. This visual representation shows us exactly where the strategy added value and where it lagged behind the broader market. In quantitative trading, raw returns only tell half the story. The other half, and often the most important part for long-term survival, is risk. This is where we look closely at the drawdown curve. The maximum drawdown measures the largest peak-to-trough decline in our account equity. For our momentum strategy, the maximum drawdown was minus 4.7%. Compare this to the buy-and-hold strategy, which suffered significant pain during market downturns like the 2020 pandemic crash and the 2022 inflation crisis. By systematically moving to cash when momentum turned negative, the strategy was able to sidestep some of the worst market sell-offs. However, it is crucial to note that momentum is not a perfect shield. Because it is a lagging indicator, it will always suffer from some drawdown before the exit signal is triggered, and it can experience painful whipsaws during highly volatile, directionless markets. To get a deeper understanding of how this strategy behaves year by year, let's break down the annual returns. Looking at the yearly performance comparison, we can see a clear pattern. In years characterized by strong, persistent trends, the momentum strategy performs exceptionally well, often matching or even exceeding the S&P 500's performance. However, in years that are highly volatile with frequent trend reversals, often called whipsaw years, the strategy tends to underperform. This is because momentum requires a trend to survive. In a flat or choppy market, the strategy will buy after a rise, only for the market to reverse, triggering a sell at a loss, and then repeat the process. This annual breakdown highlights the cyclical nature of momentum. It is not a strategy that wins every single year, but rather one that aims to outperform over a full market cycle by winning big during major trends and protecting capital during major crises. Let's summarize the key performance metrics of this backtest to get a complete statistical picture. With a total of 13 trades over 10 years, this is a very low turnover strategy. This low trading frequency is a major advantage because it keeps transaction costs and slippage to an absolute minimum, which is a common pitfall for high-frequency trading models. The win rate of 53.8% might seem modest to some, but in trend following and momentum trading, a high win rate is not actually required. What matters is the asymmetry of the trades. The strategy aims to have small, controlled losses on its losing trades, while letting its winning trades run for massive gains. When you combine this distribution with a solid CAGR of plus 2.9% and a controlled maximum drawdown of minus 4.7%, the statistical profile of the 12-month momentum strategy, Jagadish and Tipman, remains highly compelling for long-term investors. Despite its historical success, we must be completely honest about the limitations of the 12-month momentum strategy, Jagadish and Tipman. The biggest threat to any momentum investor is what academics call a momentum crash. This typically happens at major market bottoms. When the market has been in a prolonged bear market, momentum indicators will have positioned you entirely in cash or defensive assets. If the market suddenly bottoms and stages a violent, rapid V-shaped recovery, the momentum strategy will be left behind. It will take several months of rising prices for the 12-month look-back period to turn positive again. By the time the strategy reinvests, a significant portion of the initial bull market gains may have already occurred. Additionally, during long periods of sideways, choppy markets, the strategy can suffer a death by 1,000 cuts, repeatedly buying high and selling low. Understanding these regimes is critical before risking real capital. In conclusion, the Jagadish and Tipman momentum anomaly remains one of the most thoroughly researched and robust phenomena in financial history. Our backtest of the 12-month momentum strategy, Jagadish and Tipman, on SPY over the last decade shows that while it is not a magic bullet that wins in every market environment, its systematic approach to trend following offers a powerful framework for managing risk and capturing long-term market trends. It forces you to cut your losses and let your winners run, overcoming the emotional biases that cause so many retail investors to fail. What are your thoughts on momentum investing? Do you prefer buying the dips, or do you like riding the waves? Let us know in the comments below. If you found this objective, data-backed analysis valuable, please hit the like button and subscribe to Backtested Hub for more honest strategy breakdowns. Until next time, trade smart and let the data guide your decisions.